Today we'll discuss about the banking sector in India. We know that in 1991, India adopted the liberalization approach as part of the globalization liberalization policy, that is liberalization, privatization, globalization program LPG, and the liberalization measures were introduced in almost all sectors like primary, secondary and tertiary sector. In accordance with that, sectoral reforms were introduced in the banking sector also, and this is termed as the banking sector reform. In Indian financial system, especially the banking industry, has experienced a process of significant structural transformation in the last few decades. The financial sector reform, introduced as an integral part of the new economic reform initiated in 1991, have touched upon almost all aspects of the banking sector. That is, the banking sector reforms were introduced as part of the financial sector reform. For a few decades preceding the onset of the banking and financial sector reforms in India, banks operated in an environment that was heavily regulated and characterized by sufficient barriers to entry, which protected them against much competition. In August 1991, the government appointed a committee under the chairmanship of M. Narasimhan, popularly known as Narasimhan Committee. That is, the banking sector reforms were under the chairmanship of the Sri M. Narasimhan, and he has appointed twice to recommend about the sector reforms in banking, and the first one was in 1991. This is known as Narasimhan Committee Report 1, and he was appointed again in 1998 as the chairman of the banking sector reform, and the report submitted by him is known as, or the suggestion given by him is known as the Narasimhan Committee Report 2. That is, the chairman of the banking sector reforms in India was Narasimhan, and his reports. And he has submitted two reports in 1991 and 1998. The first report is known as Narasimhan Committee Report 1, and the second one Narasimhan Committee Report 2. And he was appointed to examine all aspects relating to the structure, organization, functions and procedures of the financial system in the context of liberalization of banking practices. That is, in 1991, he was appointed as the chairman of banking sector reform, and he examined the aspects relating to the structure, organization, functions and procedures of the financial system in the context of liberalization of banking practices. And the aim of this committee was to bring operational flexibility and functional autonomy so as to enhance efficiency, productivity and profitability of the bank. And the committee submitted its report in November 1991. In August, he was appointed, and in November 1991, he submitted the report. And the aim of this committee was to bring operational flexibility, that is, give some flexibility, operational flexibility to the bank. Second one, functional autonomy, that is, autonomy means freedom to work. Functional autonomy must be granted to the banks. These two, operational flexibility and functional autonomy, are to enhance efficiency, productivity and profitability of the bank. And he chaired another committee on banking sector reform, which submitted its report on April 1998. This committee is known as Narasimhan Committee 2, which focused on bringing about structural changes so as to strengthen the foundation of the banking system. Earlier, the aims at bringing the flexibility and autonomy, and in the second report, they mainly focused on the structural changes to be introduced into banking system, and these structural changes are to strengthen the foundation of Indian banking system. And the major recommendations of the Narasimhan Committee Report 1 is given in this slide. And the first recommendation, and the recommendation of the Narasimhan Committee Report 1 is given here: reduction in SLR and CRR. The First important recommendation was reduce the statutory liquidity ratio and cash reserve ratio. The committee recommended the reduction of higher proportion of the SLR and cash reserve ratio. That is, both of these ratios were very high at that time. SLR was nearly 38.5 and CRR was 15%. This high amount of CRR and SLR meant locking the banking resources for government uses. It was hindrance into productivity of bank, and thus the committee recommended their gradual reduction. SLR was recommended to reduce from 38.5 to 25 and CRR from 15% to 3 to 5%. This was the first important recommendation, that is reduction of SLR and CRR. These are the proportion to be kept with the bank itself. It cannot be used for other productive purposes. At that time SLR was 38.5. that is a huge amount or very high percentage, and CRR also was very high. It was 15%, and they recommended to bring down it to 25 and 3 to 5%. This was the first recommendation. Second recommendation was phase out direct credit program. That is, phase out direct credit program was that in India, since nationalization, direct credit programs were adopted by the government. The committee recommended phasing out of this program. This program compelled banks to earmark their financial resources for the needy and poor sectors at a concessional rate of interest. It was reducing the profitability of bank, and thus the committee recommended the stopping of this program. There is phasing out direct credit program means since nationalization, the government has directed the bank to provide loans and other advances to certain sectors at a reduced rate of interest, but this was creating problems to their profitability and the performance. And the committee recommended to phase out such direct credit programs. Then another recommendation is with respect to the interest rate determination, that the committee felt that interest rate in India are regulated and controlled by the authorities. The determination of interest rate should be on the ground of the market forces such as demand for and supply of the funds. That is, here the committee recommended that at that time the rate of interest was determined by the RBI, and the committee recommended that it should be left to the market forces. That is, the demand for and supply of the fund must determine the interest rate. And next important recommendation is with respect to the structural reorganization of banking sector. Structural reorganization means that the committee recommended that the actual number of the public sector banks needs to be reduced. Number of public sector banks must be reduced, and there should be a 4-tier system. 3 to 4 big banks including SBI should be developed as an international bank. This is the first layer. 8 to 10 banks having nationwide presence should concentrate on the national and universal banking service. Third one, local banks should concentrate on the regional specific, and regarding the regional rural banks, it should ensure that the development of the regional sectors. This is the 4-layer banking system suggested by the Narasimha Committee Report 1. It is at the top level, few banks of international character, then 8 to 10 banks of national character, then local banks for regional development, and at the bottom level, regional rural banks. This was the structure recommended by the Narasimha Committee. Then another one is establishment of Asset Reconstruction Fund Tribunal. That is, Asset Reconstruction Fund is to meet the problems with respect to the non-performing asset. Non-performing assets means assets that are default, that is loans and advances that are not repaid by the borrower is termed as non-performing asset. And in order to meet the problem, these NPAs are non-performing asset or NPAs were increasing at an increasing rate, and this has brought down the profitability and performance of the bank, and therefore the committee recommended to construct or recommended to introduce an asset reconstruction fund for meeting the problems of the non-performing asset or the bad debt. Then another one, removal of dual controls. Then at that time, the banks were under dual control of Reserve Bank of India and the banking division of the Ministry of Finance. The committee recommended the stepping up of the system. It considered and recommended that RBI should be the only main agency to regulate banking in India. And next important recommendation was banking autonomy. The committee recommended that public sector banks should be free and autonomous. In order to pursue the competitiveness and efficiency, the bank must enjoy autonomy so that they can reform the work culture and banking technology. Regulation will be easy. And these are the recommendations of the Narsim Committee 1, that is reduction in CRR SLR, phasing out of direct credit program, interest rate determination, that market forces to determine the interest rate, then structural reorganization of bank, that is four-tier banking system, establishment of asset reconstruction fund for meeting the non-performing or bad asset, then removal of dual control, that is control. At that time, the banking sector were controlled by RBI and the banking division of Ministry of Finance, and they should be removed, and the authority must be given to the Reserve Bank of India, and functional autonomy must be given to the public sector bank, that is banking autonomy. Here, the recommendation of the Narasimhan Committee Report 2 1998 is given, and they mainly aims at a structural reorganization of banking and banking in India, and thereby strengthening the bank. And the recommendations given by them include strengthening the banks in India. The committee considered that stronger banking system in the context of the current account convertibility. It thought that Indian banks must be enabled of handling the problem with respect to the domestic liquidity and exchange rate management in the light of the current account capital convertibility. And next one, narrow banking. Narrow banking means those days many public sector banks were facing the problem of non-performing asset, and some of them had NPAs very high as 20% of their asset. Thus, the successful rehabilitation of these banks, it recommended the narrow banking concept, where weak banks will be allowed to place their funds only in the short term and risk-free assets. Then capital adequacy ratio was also introduced, and that is capital adequacy ratio. In order to improve the inherent strength of the Indian banking system, the committee recommended that the government should raise the present capital adequacy norms, and this will further improve their absorption capacity. Also, but Indian 9%, the capital adequacy ratio was 9%, and it must be increased. Capital adequacy ratio is the ratio of good asset to the bad asset or risk weighted asset. Bank ownership, that is the freedom of operation, freedom for banks in its working, and bank autonomy must be given to the banks. Then review of banking laws. Another important recommendation given by the Narasimhan Committee Report 2 was the review of the banking system. The impact. What was the impact of these two recommendations on Indian banking sector is given here. That is, we have seen two committees and their two sets of recommendation. What was the impact of these recommendations on Indian banking sector is given here. And as a result of the recommendations by the Narasimhan Committee, in India, CRR and SLR were reduced. This was the most important and significant impact of the banking sector reforms. That is, CRR and SLR was reduced. The cash reserve and statutory liquidity ratios were reduced from to the level of 3, and SLR was reduced from 38.5 to 25%. And the deregulation of interest rate was also introduced in the Indian banking system. Now the interest rate is determined by the demand and supply forces. Then fixing the prudential norm in accordance with the recommendations of the Banking Sector Reform Committee, prudential norms or professionalism was imparted in the banking system. RBI fixed the prudential norms for the commercial banks. It included recognition of income sources, classification of assets, provision of bad debt, maintaining international standard in accounting practice, etc. It helped banking in reducing and restructuring the NPA. That is, prudential norms means introduction of professionalism in the banking system. Some policy measures were introduced for improving their professionalism in the banking system. This was the third important impact. Then introduction of capital to risk weighted asset ratio, that is capital adequacy ratio. Increase in the capital adequacy ratio was one of the important recommendation in accordance with that capital to risk weighted asset ratio, CRAR. Capital, good capital to risk weighted asset ratio, that is CRAR, was introduced 1992. It resulted in an improvement in the capital position of the commercial banks. Almost all banks in India has reached the capital adequacy ratio above the statutory level of 9%. Then operational autonomy was introduced in the banking sector. Then banking diversification. Then bank system was diverse during the economic period. Many of the banks were started new services, new products. Some of them have established subsidiaries in merchant banking, mutual funds, insurance, venture capital, etc. And another one is the introduction of new generation bank. During the reform period, we saw the introduction of so many new banks. These new banks are known as new generation banks. Banks such as ICICI Bank, HDFC Bank, UTI Bank. These are the results of these economic reforms or bank sector reforms, and the new generation banks were also emerged as a result of this bank sector reform. Another one is improved profitability and efficiency. That is, in Indian banking system, the profitability and efficiency was enhanced due to the bank sector reforms. So many changes were introduced, that is, technology changes were introduced, capitalization measures were introduced, and so many innovative measures were introduced in banking system. As a result, it improved the efficiency and profitability of the banking system.